In this video, we'll put some fundamental context around the recent movements that we've seen in the stock, bond, and currency markets. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. If you've been close to the markets during this period here, you know that in an inflationary boom, leverage tends to increase from an investment perspective, margin and balance sheets. We get a weaker US dollar. When the market rallied off a low during these periods, especially closer to 2011, from 2000 to 2011, a rally often was led by weak dollar assets such as emerging markets, precious metals, energy, and small caps. During an inflationary boom, there's a fear of inflation, which typically causes bonds to lag stocks. And our stock-bond ratio tends to be more binary. When I'm confident, I'd rather be in stocks for these reasons. When I'm not confident, we shift to more of a traditional deflationary look. If you invest in multiple asset classes or a broad base of ETFs, you know that this has not been happening really since 2011. So instead of being in an inflationary boom, it's possible that we're in a deflationary boom, where deleveraging is still taking place. Rather than the dollar being weak, it's been strong. Your market leaders look different, and your market laggards look different. Instead of a fear of inflation, we have a fear of deflation. Thus, we have a higher demand for bonds even during the bullish phase in the stock market. As a result, the stock-bond ratio is much less binary than it was here. Risk on here is a confident risk on. Risk on here is much, much less confident. If we're in a deflationary boom, which is just a possibility, but we are seeing these type of characteristics, we have to acknowledge that change is not uncommon. There are secular shifts all the time in the markets. They just take place over longer periods of time. The good news is, under all scenarios, whether you're in a deflationary boom or an inflationary boom, risk off or a bear market pretty much looks the same. It's a deflationary event, and people will migrate to the safest of safe, longer maturity bonds. If we are indeed in a deflationary boom, and that's yet to be determined, it's quite a bit different from an inflationary boom. This is somewhat of the cycle of how a bull market shifts to a bear market. This is what we've all lived through. The transition from a bull to a bear in a deflationary boom may be quite a bit different. A deflationary boom usually takes place after an inflationary boom. We just had one where deleveraging is taking place. You get slower growth, and as a result, the Fed keeps interest rates low for a long period of time. The stock market tends to do well in this environment for different reasons than it does in this environment. For the most part, a lot of the money that's going into the stock market has been forced into the stock market because it's very, very difficult to make money in CDs or bonds in this environment. Even though some people own stocks, they still are very, very leery about economic conditions. During a deflationary boom, there's a relatively large subset of investors that are in stocks that believe the Fed created all of this, and they don't trust the stock market, they don't trust the economy, and they don't trust the system. In an inflationary boom, typically, the economy begins to contract, and then we have a bear market. In this world, it may be quite a bit different. We could get to a point where money is being forced into the stock market, and at some point, valuations relative to slow growth become a problem. the stock market drops, and that impacts the economy and drags it into a recession, and hence we end up in a bear market. In this scenario, it could actually be the financial markets that kick off the next recession. That's a little bit different than the world we all grew up in. Before we cover possible investment scenarios, it's important to understand in an inflationary boom, stocks and weak dollar assets tend to do well. It's quite a bit different than what happens during a deflationary boom. As always, it's extremely important to keep an open mind about where we go next. Let's look at some scenarios here. If we assume we're in a deflationary boom, basically one of two things can happen from here. One path is that economic growth picks up and inflation picks up, and we morph into a more traditional inflationary boom. When inflation starts to become a problem, the Fed is forced to raise interest rates, and eventually you get an economic contraction and a bear market. Under this path, eventually bonds win. If we go from a deflationary boom to a point where valuations relative to slow growth become a problem, or the fear of interest rate hikes from the Fed cause the market to drop, that in turn could drag down the economy even further, and we could move into the deflationary bust cycle. Circling back to the is the market broken question, no, the market's not broken. The indecisiveness makes perfect sense. Why? If we head in this direction, there's high risk in bonds. If inflation picks up and interest rates go up, bonds could get killed. If we move in this direction, there could be very high risk in stocks because the market could drop rapidly, and it could be the market that kicks off the next recession. So rather than being broken, the stock market and bond market are acting fairly rationally at this point. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.